Welcome to the award-winning Consumer Finance Monitor podcast, where we explore important new developments in the world of consumer financial services and what they mean for your business, your customers, and the industry. This is a weekly show brought to you by the Consumer Financial Services Group at the Ballard, Spahr law firm. And I'm your host, Alan Kaplinsky, the founder and former practice group leader for 25 years, and now senior counsel of the Consumer Financial Services Group at Ballard, Spahr. And I will be hosting and moderating today's program. For those of you who want even more information, either about the topic we're going to be discussing today or anything else in the world of consumer finance, don't forget about our blog, consumerfinancemonitor.com. We've hosted the blog since 2011 when the CFPB became operational, so there's a lot of relevant industry content there. We also regularly host webinars on subjects of interest to those in the industry. So to subscribe to our blog or to get on the list for our webinars, please visit us at ballardspahr.com. And if you like our podcast, please let us know. You can leave us a review on whatever platform you're using to access the podcast today. Also, please let us know if you have any ideas for other topics we should consider covering or speakers that we should consider inviting as guests on our show. Well, now, today's program focuses on one of the most consequential and rapidly evolving areas of bank regulation, and that is anti-money laundering and counter-terrorist financing, and how that framework has changed since President Trump took office. Well, anti-money laundering laws, and we refer to it as in the shorthand AML, they've been a central feature of bank regulation for decades, rooted primarily in the Bank Secrecy Act and strengthened significantly by the USA Patriot Act. The last several years have brought meaningful shifts in priorities, enforcement posture, and regulatory philosophy that banks cannot afford to ignore. We've seen a renewed emphasis on national security and financial crime prevention, coupled with increased attention to sanctions compliance, beneficial ownership reporting, information sharing, and the role of banks as gatekeepers to the financial system. At the same time, regulators and policymakers have continued to wrestle with long-standing concerns about the cost, the effectiveness, and the operational burden of AML compliance, particularly for banks, and particularly for community banks. Against that backdrop, the Trump administration has advanced policies and initiatives that are already influencing how AML requirements are interpreted, enforced, and supervised. These developments raise important questions for banks. How should institutions be adjusting their AML risk assessments and compliance programs? What changes are we seeing or expecting in regulatory expectations and enforcement priorities? And how do banks balance innovation, efficiency, and customer access with heightened AML and national security concerns? So to help us navigate these issues, these issues that I've outlined, I'm very pleased to be joined today by Terence, and everybody calls him Terry Grugan, as co-chair of our AML team. Terry is widely recognized for his deep experience in anti-money laundering, financial crimes compliance, and bank regulatory matters. He spent years advising and working with banks on the design, implementation, and evaluation of AML programs, and he brings to the table a practical, real-world perspective on how regulatory policy translates into day-to-day compliance challenges for financial institutions. So, Terry, very warm welcome to you.
Thank you, Alan. I'm very happy to be here, and thank you very much for having me.
It's my pleasure. So, I have a number of questions for you, Terry. I'm going to start with a very general one, and a lot has happened in 2025, and at least looking at it from my perspective, it looks like there's sort of a movement toward not making AML compliance as burdensome as it has been in the past. But I know that's an oversimplification. So tell us, what are the key developments in the AML world that our listeners ought to be aware of?
So you're exactly right that the focus has become more towards simplifying compliance, adding efficiencies, banks and financial institutions, AML programs. And 2025 was especially notable in that regard, not so much for how much the law and regulatory environment developed, but for how it's begun to contract somewhat. The Department of the Treasury has really keyed into driving economic growth as its central, almost exclusive focus. And in the interest of driving economic growth, the key word in this area, among others, has been deregulation. As you alluded to, an overarching concern has always been that overregulation inhibits growth by increasing the burden on regulated businesses and stifling innovation. And we see that across government, whether it's minimizing CFPB or limiting enforcement actions through the SEC. And so to really see how deregulation has impacted the AML space, we can start off by looking at the regulatory expansion or attempted expansion that we saw just prior to the Trump administration taking office in 2024 against actions that were taken to reset regulatory priorities in 2025.
Okay, so what were the regulatory efforts that were scaled back? Are those things that began during the Biden administration that were scaled back in 2025?
So there were a couple of real big events in the AML space during the Biden administration broadly, and then specifically in 2024. The headliner would have been the Corporate Transparency Act, and we've heard a great deal about that. Hailed at its passage as providing what would be a vital tool for combating money laundering and financial crime, the CTA has kind of died a slow death throughout 2024 and into 2025. As I'm sure many of your listeners will recall, the CTA was intended to develop a comprehensive database of beneficial owners for corporate entities, for the purpose of eliminating anonymous shell companies and providing more transparent business environment. But the CTA faced numerous challenges in court. It still is facing challenges in court and being litigated. But from a regulatory standpoint, Treasury has stepped in to defang it. It announced that it would not enforce the CTA's penalty provisions and would limit the reporting obligations to foreign companies only, essentially gutting the purpose of the CTA. After that, the Biden administration really wanted to expand the reach of the anti-money laundering laws into other areas of the financial system that weren't historically regulated. One of those was the area of investment advisors. And in 2024, FinCEN passed a new rule that would extend the Bank Secrecy Act to most licensed investment advisors. It is another rule that had been a long time coming, but of course met with pretty fierce resistance from the industry. Specifically, the rule would require investment advisors to meet the full panoply of BSA requirements, including transaction monitoring, suspicious activity reporting. Originally, the rule was set to take effect on January 1st, 2026, but FinCEN has revised the effective date of that rule to January 1st, 2028. Not only that, but it's indicated that it will use the intervening time to reassess the scope of the rule. So I think we can expect there will be further changes to the substance of that. One other area that the Biden administration really tried to push into to combat money laundering was the real estate industry, which generally falls outside of BSA requirements. And FinCEN had published a new rule that would require reporting of certain all-cash residential real estate transactions, imposing this reporting obligation on various professionals involved in those transactions, including attorneys, title agents. There was a waterfall effect to figure out who the most appropriate reporting person was. Originally, that rule would have taken effect a few weeks ago on December 1st, 2025. But recently, FinCEN delayed the effective date to March 1st, 2026. Now, this actually presents kind of an interesting case to see where the current administration is going to go. It didn't kind of gut the real estate rule as it did with the CTA, or it didn't almost indefinitely push out its effectiveness by several years as it did with the IA rule, but only delayed it a few months. So the question is, what are we going to see happen? Will it go into effect as expected, or will there be further revisions? And given the comments from FinCEN, from Treasury, knowing what the administration's priorities are, I think the assumption is that we may see some scaling back, or if not delaying, of that rule further.
Okay. So does this mean a return to the status quo of, say, 2020?
I mean, yes and no. In terms of sort of scope, perhaps. Under the Biden administration, FinCEN moved at a pretty rapid clip to expand the reach of the Bank Secrecy Act. And as we just talked about, and that's been scaled back. We're at the point where traditional financial institutions, banks, broker-dealers, casinos, they're still obviously subject to the BSA, and the compliance obligations in kind are unchanged. Covered financial institutions still must maintain BSA AML compliance policies that include adequate customer due diligence, transaction monitoring, suspicious activity reporting, training, designation of a BSA officer. So the requirements are still the same, but Treasury is taking real steps to reduce the burden of complying with those obligations, of modernizing compliance, adding efficiencies, while also focusing compliance towards the administration's core priorities and de-emphasizing or entirely discounting the priorities of the Biden administration. And there's areas that we can talk about where they've made very specific changes to requirements for institutions that I can get into, such as modifications to SAR reporting requirements.
Yeah, what have they done there? Because that's always been a major headache for banks, trying to figure out what they ought to report, and it's a lot of paperwork there.
Yep, and you're exactly right. It is a perpetual complaint from financial institutions concerning the paper and the effort burden of SAR reporting. And millions of SARs are produced each year. And there's the very big and very real question of what's the utility of so much reporting. Imagine 1 million tips going into a tip hotline. Law enforcement can't listen to them all, let alone investigate them all, let alone use them to preemptively combat money laundering or whatever the subject is. And so the argument typically goes that that compliance is very costly, very time consuming, and really just for sake of compliance and to avoid an enforcement action. So, while SARs themselves serve arguably, to some limited use, failing to make them can lead to really significant penalties for reporting companies. So FinCEN has begun making efforts to add efficiencies and emphasize effectiveness in SAR reporting. In October, it released guidelines refining SAR reporting obligations in 4 pretty key areas: structuring related SARs, continuing activity reviews, timelines for continuing activity, and certain documentation requirements. Taking those in turn, FinCEN has narrowed the circumstances where a financial institution is required to file a SAR where transactions are suspected of structuring. And for those who don't know, that's committing a series of transactions designed to evade the $10,000 currency transaction report threshold. Now, previously, transactions that simply approached that monetary threshold required the filing of a SAR. But now, FinCEN's clarified that a SAR is not required in the absence of any knowledge or suspicion that the transactions are structuring related. So that's a really key addition there. It's not just the numbers dictate whether or not a SAR has to be filed. It's you need to have some extra on top of that indicates that there's a suspicion of structuring to it. Financial institutions are also required to monitor whether suspicious activity is ongoing after a SAR has been filed. But FinCEN has now clarified that financial institutions are not required to independently review a customer or an account to evaluate whether suspicious activity continues after the filing of a SAR. Instead, and that, as you can imagine, just adds another layer of review and examination on top of the already existing transaction reviews and monitoring. So instead, financial institutions can simply rely on their standard monitoring policies and report continuing suspicious activity where appropriate, where it's uncovered through standard monitoring. And in addition, another kind of key change is FinCEN's clarified that financial institutions do not have to document the decision to not file a SAR. That's another area that added a lot of work for financial institutions, and arguably was a very limited utility. So that is a pretty key area. So taken together, these clarifications really materially reduce the amount of work that financial institutions have to put into monitoring for and reporting on suspicious activity.
Yeah. So the examinations are still going on, right, to determine whether financial institutions are complying with AML and BSA. I mean, they haven't stopped examining, right?
No, of course, absolutely.
So who's doing the examinations? The banking regulators, when they come in to do their regular safety and soundness exams, AML is still part of that, I take it.
Of course, yeah. Bank regulators are still examining the effectiveness of programs and still conducting them annually or semi-annually. But, again, in that area, this past year, there's been further effort to reduce the burden of those examinations, specifically on community banks.
Yeah, what are they doing? They're trying to make it easier for community banks, I take it.
Absolutely. Community banks, as we know, they're smaller, more localized financial institutions, typically with lower thresholds of assets. And the idea behind the OCC released an alert, or just this past October, the idea was that they want to ease that supervisory burden for community banks, really ensuring that community banks can devote their resources to serving their communities rather than responding to regulatory oversight. So the OCC's modified its examination standards for community banks, and that their modification really starts from the premise that most community banks are well capitalized, they're well managed, and they generally don't engage in really high risk activity. And yet they are still subject to pretty significant regulatory burden for areas that might not actually, for risks that might not actually be implicated by individual banks. So, OCC typically is required by statute to conduct full on-site examinations of every bank every 12 to 18 months. And typically, historically, OCC that's Office of the Comptroller of Currency, typically OCC would conduct these examinations just according to OCC policy, rather than in a way that was tailored to individual banks and individual banks' risk profiles. So it's resulted in a pretty extensive by-the-book examinations for all banks, regardless of the risks that particular bank would present. Now, beginning on January 1st, 2026, OCC is eliminating the requirement that all community banks be subject to examinations that meet its general policies and standards. Instead, OCC examiners are being instructed to tailor their examinations to the specific bank's specific activities in light of their size, in light of their complexity, the complexity of their business operations, and in light of their risk profile. So, in practice, this will really streamline the examination process for community banks. Just as an example that OCC itself noted, OCC policy requires that every examination include evaluation of fair lending risk, include testing for flood insurance coverage. This is two examples. But the new OCC guidelines using those examples will eliminate these requirements where specific banks don't present those specific risks or in other specific areas, which makes a lot of sense that you would tailor an examination like that. And on top of tailoring the bank examinations, OCC will now rely more substantively on the bank's own audits, risk management efforts, and reporting functions. So there's a lot of duplication there when banks are conducting their own evaluations of their own compliance programs as is required. Then to have a regulator come in on top of that, it's almost having a lot of evaluations be done twice. So if the functions are deemed reliable, OCC is going to rely more on those results to avoid duplicating those examination efforts.
Right. It seems, Terry, that what you've described with respect to community banks, it's also, I think, not quite as rapidly, but the prudential banking regulators are trying to get away from the old check the box kind of exams where, they didn't really initially, or as a threshold matter, figure out the risk profile of the financial institution that they're examining and focus on the major risks to the institution. And instead, they would have detailed pages of check this, does the bank do that, and would go on and on and on. And it was really very time consuming, both on the part of the examiners and on the part of the banks being examined. So they're trying to take a fresh look at examinations in general. And I guess it is natural that AML would also be considered to be something that where the exams could be more focused in nature. And at least that's how I'm looking at it from a big picture standpoint. Let me ask you this, and I want to get into enforcement. Is it my imagination, or is it really true that there have been very few, if any, announcements by DOJ or anybody or any of the bank regulators of any financial institutions paying big fines this year for AML violations? I just, it's not something I focus on all that much, but in prior years, you'd see, several announcements during the year, and they'd be enormous fines and penalties, the kinds of fines that, could really shake up a bank. And I just haven't seen it this year. Is it going on? It's just not being, they're smaller in nature. It's not attracting a lot of media attention. What are you seeing, Terry?
No, I think that's exactly right. And we'll get a look at the statistics as the year closes, but we haven't seen a ton of those big compliance-related fines. We've seen actions directed towards cartels, for instance, or directing financial institutions to not bank with certain institutions that are related to cartels. We've seen a lot of action like that, but we haven't really seen the big fines for failure to report SARs that we've seen in the past. And that really goes to the administration's priorities and there's been some developments that have come out even recently on this, goes to the administration's priorities to, one, get to the heart of what the purpose of the anti-money laundering laws are. The idea is to prevent money laundering. So what does an enforcement action or does a regulatory approach actually preemptively help to prevent money laundering, or is it just punishing lack of compliance? And then two, what are the specific areas, like substantive areas that the government's looking into? DOJ announced pretty early in the Trump administration that just a complete shifting of its general criminal law enforcement policies. And, out, for instance, was a lot of sanctions compliance. In was immigration and cartels. And so that then shifts what banks need to be looking at too. I mean, what is the risk? The risk that banks evaluate or financial institutions consider need to correspond with the administration's priorities. So the idea really has been using these laws to disrupt cartels and to get to immigration-related issues more than just policing compliance. So you're right. And we're going to see probably even fewer big penalties in the future.
Yeah. So what about non-banks? I mean, we've been talking up until this point, mostly about banks. But as you pointed out at the beginning, there are certain categories of non-banks that are subject to AML. Anything going on there?
Yeah. And I mean, there's the announcement of big changes to come is probably the best way to put it. So regarding non-bank financial institutions, FinCEN issued a notice of proposed rulemaking that they want to gather information concerning compliance. In September, they issued this notice. They want to send out surveys and have financial institutions, non-bank financial institutions, calling the survey a survey of the costs of anti-money laundering and countering the financing of terrorism compliance. FinCEN intends to gather this information on direct compliance costs incurred by non-bank financial institutions. The notice was directed to, as you mentioned, different areas of financial institutions. That would be casinos, card clubs, money services businesses, insurance companies, dealers in precious metals and stones, operators of credit card systems, and loan or finance companies. So those would be the non-bank financial institutions. And FinCEN was pretty explicit in its purpose in this notice. They want to scale back non-bank financial institutions' compliance obligations. So now these things don't happen. FinCEN is not just going to say tomorrow it's going to eliminate certain regulations. There's an entire rulemaking process, which is why they're gathering this data to determine how much they want to scale back the compliance burden for non-bank financial institutions. So it's seeking information from the subjects on a number of categories. One, the practical utility of compliance obligations, whether assumptions concerning compliance time and costs are accurate. When FinCEN puts in a new rule, it adopts the rule with an assumption of how much time and cost it'll inflict on the regulated body. Are those accurate? On what ways are there to add efficiencies to the compliance process, and the ways information technology or other automated techniques can reduce manpower expended on compliance. And we're gathering this information. The comment period just closed on December 1st. And so I would expect to see release in the next year something addressing what I think it was safe to assume will be a lot of comments identifying inefficiencies and burdens and costs of compliance, which will be inevitably juxtaposed against somewhat limited utility of it. So we don't have concrete rules now or elimination of rules right now for non-bank financial institutions, but that's on deck for next year.
Okay. Let me ask you about crypto. I mean, I assume that AML would apply to crypto transactions as well, right? Doesn't have to be U.S. currency.
Well, no, it will apply. No? I'm sorry. No, it doesn't have to be U.S. currency for the BSA to apply. It has to be a unit of value. So yeah. But then how and where does the BSA apply to the various actors in the cryptocurrency market? So a trading platform, for instance, you're not going to get around that units of value are being exchanged. And so for trading platforms, naturally, the BSA would apply. But there's been, I don't want to speak in absolutes, but it's hard to imagine an area where that has become less regulated this year relative to the past than crypto. Previously we had SEC kind of categorizing most cryptocurrencies as a security. And then that brings in actors who would be considered broker-dealers or traders that would then have BSA obligations. But now it's not generally not considered a security, generally not considered a commodity. So it falls into a pretty unregulated space. So there's a lot of actors in the crypto chain and the crypto market that aren't subject to these regulations as they were. And naturally what we're seeing, and there's been reports on this recently, we're seeing just an enormous amount of money laundering in cryptocurrency, just a staggering sums.
Right. But is the government able to identify what's going on and go after the wrongdoers, or you just think they've turned a blind eye to it, or they don't want to do anything to hurt crypto because it's very important to this administration?
So think of it like your typical money laundering or financial transaction that's conducted through a bank. The bank is responsible for monitoring for that, for reporting on it, for detecting it. But the bank's not the money launderer, but the bank can be punished for it. So you don't have the bank equivalent of crypto that now is deputized to help police this area. The government has said basically it wants to punish wrongdoers. Of course it does. But by that, it means the drug dealers who are using cryptocurrency or the money launderers themselves, not the facilitators, the people who are initiating transactions, the companies that are launching tokens that are exploited for money laundering. They're not being policed in the same way that they were.
Yeah. So I'm wondering whether that might change at all with the enactment of the so-called Genius Act that basically regulates to quite an extent, requires licensing of companies that are issuers of stablecoin. I wonder, if that event, it won't happen overnight, but if it'll eventually mean that companies that or banks that get into issuing a stablecoin are going to have to have compliance policies that pertain to AML.
Sure, and that's right. But that'll be limited to stablecoins, as you mentioned, not to your cryptocurrencies more generally.
Yeah. Tell me, Terry, what is there anything else going on that we haven't touched upon before we close out our podcast for today? Or do you think we've hit it all?
No, I mean, there's always a lot going on. We could talk about this for hours, but I think one of the biggest developments was actually very recently, and it's maybe less a development than a promise of a development to come. But recently, just a few weeks ago, Treasury Secretary Bessent issued a draft term sheet to all the nation's various bank regulators, proposing that the Treasury Department take a more central role in enforcement of the anti-money laundering rules. And this really gets to what we were talking about earlier, how in past years you would see Bank X fined $75 million for failure to report SARs when it wasn't actually connected to a specific wrongdoing. It was just a compliance violation. So this proposal is kind of in direct response to compliance for compliance sake, that enforcement generally targets technical compliance with obligations, but does little, if anything, to actually prevent money laundering. So under Treasury's proposal, FinCEN would have the ability to veto any finding by another bank regulator that a bank has infringed the BSA. The idea here would be to have FinCEN as an enforcement gatekeeper. And to sort of save banks from penalties from mere technical violations of the BSA that weren't tied to the more substantive offenses. So if that happens, that's a huge development. And that's what was just reported within the last 2 weeks.
Is it a proposed regulation, or is just like a statement of policy that he's announced?
Right now,
how would you
it's more a statement of policy. But then, so we'll have to see how that is implemented going forward. It may be. Well, I don't want to speculate on how it could turn out. But there hasn't been a specific rule exactly, but just an indication that Treasury wants to, place itself as a gatekeeper for enforcement.
Right. Got it. Okay. Well, that certainly is a very important development. Okay. Well, we have come to the end of our podcast for today, Terry, and want to thank you very much for taking the time to share with our audience the key developments that have been happening in the AML field. And, I really appreciate what you've done. So to make sure that you don't miss any of our future episodes, you can subscribe to our show on your favorite podcast platform, Apple Podcasts, YouTube, Spotify, or wherever you listen. And don't forget to check out our blog, consumerfinancemonitor.com, for daily insights on the financial services industry. And you have am I right, Terry? You've got a blog dealing with cyber developments or AML. What is that called?
That's moneylaunderingnews.com. And there's always developments to read about there. So please check it out and subscribe.
Yeah, great. And again, as I said at the outset of the program, if you have any questions or suggestions for our show, please email us at podcast, that's singular, at ballardspar.com. And stay tuned each Thursday for a new episode of our show. Thank you very much for listening, and have a good day.